Hey, what's up, everybody? Sean Williams here, and I'm the Chief Lending Officer of Marine Bank and Trust. Rather than provide my normal weekly recap on the economy, I wanted to do something a little different because I've been getting a lot of questions about whether I think we're in a housing bubble, whether I think the housing market is going to crash, and I'm also getting a lot of questions about where I think things are headed for the rest of the year. So rather than do my usual weekly recap, I'm going to do a deeper dive into these topics. But I'm also going to talk about the affordability situation as well, which is obviously a big question on a lot of people's minds. Now, before I get into my presentation and make my case, I want to be very clear that the market is constantly in flux right now. And sometimes things feel like they're changing on a dime, moment by moment. So by no means does this presentation represent the views of my employer. This is just my personal opinion on where things stand now and where I think they might be headed. So now that I've made the lawyers happy with all my fancy disclaimers, let's hop right in and get started. First question, are we headed for a housing crash similar to 2008? I mean, you pretty much can't turn on the news right now or look at something online and not hear something about the housing market that may have some sort of inference to whether we're in a bubble or whether things are about to crash. So what I want to do is provide some context to everything and hopefully provide a fresh perspective. So let's start with this first graphic right here. This shows home values going all the way back to World War II. And if you think about that, the reason we go back to World War II is that was really the start of the modern day housing boom here in America. I mean, if you think about the GIs coming back from the war and the GI Bill that provided for their education, it also provided them the ability to go out and buy a home. And ever since then, up until today, there's only been one time in this country where homes lost significant value. And of course, that was back in 2008. Now, back in 2008, we saw homes lose value really for two reasons. First, extremely loose lending standards. I mean, if you think back then, no income, no job, no verification. I mean, all you had to do was fog a mirror and you could get a loan. And we know how that ended up. Now, the second reason was an extreme number of cash out refinances. I mean, people took all the equity they had out of their home. They cashed it all out. They bought jet skis, boats, went on vacation. I mean, it was good times. It was fun. And everyone was living in a fantasy lifestyle, thinking it would never end. But of course, it did end, and it ended really bad. So think about that for just a moment. I mean, back in the mid-2000s, you could apply for a loan that you didn't have to qualify for, and then you could take all the equity out of your home and spend it on whatever you wanted. And so when 2008 finally arrived and the music stopped, homes lost value. Now, I'm going to break this down further in just a minute, and I've got a few graphics on why this market is different from 2008, but I think it's important to understand that 2008 really was the only time that homes lost significant value in this country. Now, the other question that sort of plays into this housing bubble question is everything that happened over the past 2 years with COVID, and specifically mortgage forbearance, which was a tool deployed by lenders to help borrowers weather the storm that their housing payments had made for them because they weren't allowed to go back to work due to the pandemic. And everybody wanted to know, what would happen when forbearance ran out? And this caused a lot of concern for a lot of people. Well, I mean, at this point, we can pretty much see that the forbearance numbers continue to edge downward. As of the most recent numbers in April, 690,000 loans are still in forbearance, which is well below where we started out in May 2020. I mean, again, the big question was, what was going to happen to all of those borrowers coming out of forbearance, and how's that going to turn out? A lot of question marks about that at the time, but now we're getting a clearer and clearer picture every day. And here's the clearest picture we have now. I mean, out of the people that entered forbearance, most have come out of it as of March 31st. 37%, which is represented here in the green area, were paid in full. Now, these are the ones that took forbearance maybe as an insurance policy and said, you know, look, I don't know what's going to happen with this COVID thing. You know, maybe they didn't really need the help, but they took it anyway. Now, 44.6% which is this blue shaded area, they went through some kind of workout with their bank. They either did a modification, a rate and term refinance, or they did a deferral where they just tacked everything onto the back end of the loan. The bottom line is 4 out of 5 people either went through a modification or they paid it off in full. And that is a very, very positive sign. Now, there's 18% that are still in some sort of trouble. I mean, they either have no loss mitigation plan or they're already into a loss mitigation plan. But the bottom line is, as you talk about a housing crash, the expiration of forbearance really isn't going to factor into the equation because most people have plenty of options to get out of their home and be made whole. I mean, if you've been negatively affected by the pandemic and you sell your home, after all the appreciation that you've seen over the last couple of years, even after you pay a commission, you'll still put some money in your pocket and you'll get to the other side of the crisis that you and your family are experiencing. So again, 2 things here. Understanding why we had the housing crisis back in 2008, and then understanding the forbearance piece is critically important. But the bottom line is here, and Danielle Hale says it really well, I think. She says, and I quote, "We have learned from history that prices can fall. The most important question is if it's going to happen right now, and that's hard to say." Meaning, it's hard to say whether a crash will happen because things are very, very different today than they were back in 2008. And so now I want to walk through a couple more graphics that I think do a really good job of visually communicating how different things are. So let's go back to 2008, when loose lending standards helped drive the housing crisis, and let's look at where we are today. Well, the bottom line is lending standards are nothing like they were in the early to mid 2000s. I mean, if you think back then, we talked about the loans that were in the market. We talked about the things that people had done that helped cause the crisis. Well, there's 2 components in this report by the Urban Institute that's outlined. First is product risk in the mortgage business, and the second is borrower risk. Now, the red area, that's your product risk. Think about that as the types of loans that are available to people, including all the crazy exotic loans that used to exist, like negative amortization, no income, no asset verification. I mean, you probably remember them. Well, that's pretty much virtually been eliminated. I mean, if you start on the left side in 1999 and work your way forward to 2021, you can see that the red portion is gone. I mean, it's just not there. And the reason is that the loans that were available back then are simply not available today. And that's a good thing. And then there's this brown orangish portion at the bottom. Well, that's your borrower risk. Think about that as the asset profile, credit score, and all the things that it takes to qualify for a loan. And those have been severely curtailed. I mean, it's gotten harder to qualify for a loan after the housing crisis. That's when the qualified mortgage came out and the ability to repay rules came out. I mean, all the things that we know about the mortgage business today that has made it much, much harder for people to qualify. And again, that's a good thing. So I think this graphic does a great job showing the differences between today and 2008. And this has naturally led to a foreclosure market in this country that's now at an all-time low. Now, obviously, the last couple of years, there's been things like a moratorium where the government stepped in and said, look, we're not going to process foreclosures during the pandemic, but that's pretty much gone now. But back during the housing crisis, I mean, there it is, shaded in red, over 9 million people went through foreclosure. And we certainly don't want to see anybody go through that again. It's obviously a tragic thing, but it's also a reality of the housing market. Sometimes, bad things happen to good people, but today's tighter lending standards have led to less foreclosures in the market. And that ought to make a lot of sense, right? I mean, if you have a highly qualified, or at least a better qualified borrower, you're going to see less defaults and less foreclosures. And that is exactly what we're seeing right now. So lending standards are not going to play a role in any housing crash. And if you needed a further example of this, let's take a look at the loans that have been given to people with a credit score less than 620. So again, go back to the housing crisis of '08. So many loans, millions of loans with a credit score less than 620. And where do we stand now? Well, according to the most recent information from the Federal Reserve, it's a fraction of where we were back then. So I think we can confidently say that lending standards are much, much different this time around, meaning that one of the major contributors of the housing crash back in 2008 is simply not around today. Now, the other question a lot of people bring up is, well, as homes have risen in value, that people aren't going to be able to support that level of debt, and that's a challenge. Well, as you can see from this slide, mortgage debt overall in this country is not a challenge. Again, this data is from the Federal Reserve. It shows the household debt service ratio for mortgages as a percentage of disposable personal income. So think about the total mortgage payments in this country divided by the total disposable personal income of this country. And where we sit today is much, much lower than where we were in the financial crisis. I mean, heck, we're even lower than we were back in the 80s and 90s. And why is that? Well, part of that is a component of rising wages. And then the other part is a component of ultra low interest rates that we had never seen before. And folks that are holding mortgages today are in much better position than they were back in the financial crisis. And I think that's partly due to the lessons that we learned back then. I mean, a lot of people said coming out of the housing crisis, we don't want to go through this again. We're actually going to maybe pay down our mortgage. We're going to put more money down. We're not going to cash out all the equity and spend it on boats and jet skis and vacations. And as you can see it right here in the numbers that are coming out today. Next, what I'm going to show you is the cash out refinance numbers. And I think they tell pretty much the same story. Now, this is a look at mortgage payments on cash out refis from Freddie Mac and the difference in the annual payments as a result of the cash out refi. So think about what the previous payment was and then the new payment after the cash out refinance on an annualized basis. So back in '06, '07, '08, there it is. You know, there was like a $3,000 to $4,000 difference in the annual mortgage payment somebody was jumping into. But what did we see in 2020 or 2021? $66 and $34. I mean, that's very, very little change in the mortgage payment after going through a cash out refi. And obviously this speaks to the low interest rates we saw, but it also speaks to people not refinancing and cashing out all their equity in their home and going out and doing something stupid with it. Again, a lot of lessons were learned back in '08. And I think we can safely say that the market dynamics are very, very different today than what they were back then. So as you keep hearing about a housing bubble that's coming or a 2008 style crash that's coming, think about these visuals. And by the way, I'd even be happy to email these visuals to you. So at the end of this presentation, I'll provide my contact information. In the meantime, the bigger question right now is what's ahead. I think many people right now are asking, what's the rest of the year going to look like? I mean, we're in the middle of May right now, and the Fed just started off the month by raising the federal funds rate. So there's a lot of questions about that. And then there's a lot of talk about a possible recession on the horizon. And for the time being, home prices are still going up, but interest rates are also going up. So there's a lot of question about what's ahead. So let me give you a little bit of perspective. The most recent updated home price forecast for 2022, the average of the forecasters is around 9% appreciation. Now, even I'll admit, this one has me scratching my head a little because, many people are saying homes are going to lose value later in the year or maybe next year, but that's not what the housing economists are saying. Now, not that they always get it right. I mean, I'm not sure we're going to see the kind of appreciation they're talking about, but because these forecasters usually have a bias to the upside. But even if you discount that back, we should still be in decent territory, especially here in Florida, where supply continues to be very limited. So as it stands, the home price expectation survey as of the first quarter of this year, they're calling for 9% appreciation for the remainder of the year. And we even see some alignment with the average of the forecasters for this year. And then beyond this year, we begin moving into what I'm going to call a much more normal rate of appreciation. Now, before the pandemic, the average appreciation in a home was just under 4% in this country. And you can see that rate, roughly speaking, for the next 4 years. You know, people want to know, I mean, are we at the top of the market? Should I buy now or should I hold off? I mean, that's a very personal decision, and there's a lot of factors that play into that. But if you believe the forecasts for price appreciation going forward, that may help you in making a powerful and confident decision. Now, what the home price expectation survey does as well is look at cumulative house price appreciation by 2026. And if we look at these, they rank them by optimists, pessimists, and then they average all the panelists right there in the middle. Now, the optimists are saying we can expect 46.5% appreciation. The pessimists, 10%. Now, admittedly, me being a stodgy banker, I'm usually in the pessimist camp. But all the panelists put together are averaging right around 26% rate of appreciation by 2026. So depending on where you sit and what you believe, I think even if you're a pessimist like me, they're calling for net positive appreciation between now and 2026. And again, I think there's a lot of people who are saying to themselves, look, I'm just going to sit on the sidelines and I'm going to wait for prices to crash. And, you know, you may be right in doing so, but these forecasts are painting a quite different picture. Now let's talk about rates. You know, when we talk about rates right now, we've certainly seen rates in the first 4 months of this year rise dramatically. We started the year off at about 3.1%. Right now, we're just over 5.25% on the average 30-year fixed. Now, Bill McBride says this, quote, based on the current estimate for the peak Fed funds rate, somewhere between 3.25% to 4%, the 30-year fixed mortgage will likely peak between 5% and 5.7%. There's some variability in relationships, so we might see rates as high as the low sixes. This all depends on inflation and the Fed funds rate, but I don't expect rates to move much higher than the current rate, although 6 is possible. And McBride is kind of hedging his bets a little in case rates do go higher than he expects, but he's saying that 6 will likely be the top end. And whether this plays out or not, I don't know. And here's the thing, neither does anybody else. But there's a lot of things that play into interest rates, so it's not an easy dynamic to forecast. It has a lot to do with inflation expectations. That's what we need to really be looking at, because inflation is the enemy of a long-term interest rate, and inflation has, unfortunately, been running at 40-year highs. So the Fed's recent actions in hiking rates are intended to tame inflation. So that's something I'm going to continue to keep my eye on, because it not only affects interest rates, it also affects affordability. Now, this is probably the hottest topic in the market right now. I mean, with prices rising and mortgage rates projected to continue rising, it's really making people have questions about affordability. So I'm going to walk through where affordability is right now and what I think it means for the housing market going forward. And I want to start with this quote from Bloomberg. They're quoting a Harris poll saying, quote, new data from the Harris poll shows 84% of Americans plan to cut back spending as a result of price spikes. More than 70% of respondents said they're feeling the effects of inflation, the most in gas prices and groceries. Look, I think we can all relate to this. We've all felt it at the gas pump. We've all felt it at the grocery store. Prices are rising all around us, and it's impacting what we can spend on a day-to-day basis. Now, for someone who's thinking about buying a home, that's a real concern, and it brings affordability into the equation. Where I think this is really impactful and really puts the most pressure is on that first-time home buyer. That person who's looking to jump into the housing market, build their net worth, grow their financial future, and it's unfortunately becoming more challenging to do that. So on this next slide, you can really see how it's played out over the past year or so. Now, this goes back to January of 2021, and it's based on a loan amount of $300,000, principal and interest. But if you were to look at January 2021, mortgage rates were at historic lows. A typical mortgage payment was about $1,200 a month, or a little bit north of that. Now, fast forward to where we are today in this rising mortgage rate environment, and things are a little different. And if we think about where mortgage rates are projected to go, and let's just say that mortgage rates are going to be around 5.5% later this year, if we believe what the experts are saying and what's projected to happen, that mortgage payment jumps up to over $1,700 a month. So if you're talking about $1,200 to $1,700, that's roughly a $500 difference. And that's putting a lot of concerns in people's minds, because it's not only costing more to buy a home, but you also have to add in all the other pressures around them. Like I said, the gas pump, the grocery store, all those things. That's hurting the first-time home buyer in particular. So what I want to do next is put affordability into context and hopefully show the bigger picture. And what we can see right now is that affordability is actually approaching more historical levels. So this is the Housing Affordability Index, and it goes all the way back to 1990. Basically works like this. The higher the bar, the more affordable homes are. So if you look at where we are over on the right today, we're at 135.4. That's the index that the National Association of Realtors is measuring. Now, obviously, homes are not as affordable as they were 10 or 12 years ago, certainly not as affordable as they were in the middle of those orange bars, which was the middle of the housing crisis. Now that's when distressed properties dominated the market. You know, short sales, foreclosures, I mean, you name it. The bottom line was homes were being sold during that period at a massive discount. Now, we're certainly not there today, but as we've seen prices rise, mortgage rates rise, homes are simply not as affordable as they were even over the last couple of years. And it's important to remember that affordability is really a measure of three key things. Now, I already mentioned prices and mortgage rates, but it's also a function of wages. Right now, all three of those things are ticking up, but historically, over the past couple of years, mortgage rates have kind of offset some of the rising prices. We're not sitting in that seat anymore, so people are now beginning to feel the affordability challenges. But here's the thing. If you go all the way back to 1990, what we can see is that homes are actually more affordable than at any time leading up to the housing crisis. So I do think context is important. So when people say homes aren't affordable anymore, I think we have to ask the question, compared to when? Now, I want to continue on and share this quote from the National Association of Realtors, because I think it also helps to paint a picture of what's really happening in the world around us. It says, and I quote, "The average consumer is spending an additional $429 monthly for items other than shelter. Meanwhile, the average weekly wages rose just $212 per month. So the consumer is short by $217 per month, and that's all a direct result of inflation and the things that we're seeing all around us and how it just simply costs more money right now. So this means the average consumer will be looking for a home that is $41,793 cheaper. So the average consumer that's looking to buy a home is reducing their price point. I mean, that is very real. And that is exactly what these dollars and cents are saying. But the big concern, I think, that a lot of real estate agents have on their minds is, does this mean that it's going to impact sales? Look, with rising mortgage rates, we know that it is going to impact it. I mean, people are going to make a decision. I mean, they're either going to jump into the market and they're going to say, yes, I want to get ahead of this. I want to get ahead of rising rates. I want to get ahead of rising prices. Or they're just going to say, you know what? This just isn't for me. Either way, a decision will be made. But the overall takeaway is that buyer demand at this point is still strong. And I don't see this impacting the overall demand that we're seeing right now, especially in Florida. There's just too many buyers in the market and so few homes for sale. So the demand is still very real. But yes, rising rates and prices will put pressure on that lower price point buyer, but overall demand remains strong. But again, this is just my opinion. And the last thing you ever want to do is make a decision based on a video you just watched on social media. So keep in mind, everything I talked about today was on a national average basis. But in actuality, all economics is local, and not all local markets are the same. Also, home buying's not for everybody. And as I said earlier, maybe the folks sitting on the sidelines will be proven right in the long run. But whatever someone is thinking about doing, it's important to get a relevant market opinion based upon facts, because there's so many media headlines, so many concerns, so many fears out there. And so right now, more than ever, people need a trusted advisor that has the local data, the local insights, the local facts that back up a relevant market opinion. And that's why you need a well-respected, licensed realtor, someone who can help coach you through this process and help you understand what you're able to afford so that you can make the best decision possible for you and your family. And that's all for now. If you'd like the slides that I presented, feel free to email me at swilliams@marinebank.bank. Again, that's S as in Sean, Williams @marinebank.bank. Thanks for watching this housing market update. Feel free to share this with your friends. Drop a comment below. Have a great day, everyone.